I meet with business owners every day who want to sell their business, and some of the conversations make me laugh and chuckle inside. Usually it goes something like this. When I start asking them how their business is doing, how much money they're making, they lean in and they say, "You don't work for the IRS, right?" I know what happens next. Every single time, it's the same exact story. They then tell me all about how much their business makes, but then tell me all of that revenue isn't on the tax returns, or it's underreported, or they have too much personal expenses stuffed into their business expense to lower taxes. Here's a novel concept: file honest and true tax returns, reporting all of your income so you can stay out of jail, one, and number two, maximize the valuation of your business. Hi, I'm Trent Lee. Over the last 5 years in a row, I've been named the #1 business broker in the country for the most closed transactions, having closed over 600 transactions. I make these videos so that I can help you one day be ready to sell your business, and when the time's right, you'll reach out to me and have me help you do that. Many small business owners may think that underreporting revenue on tax returns is a harmless way to save on taxes. However, from a business broker standpoint, this practice can have a significant consequence, especially when it comes to valuing your business and having potential buyers or investors buy your business. When you're looking to sell your business or attract investors, accurate financial information is paramount. Business valuations are a complex process, and it considers various factors. Revenue is a key component. Underreporting revenue can distort the financial picture of your business, leading to an inaccurate valuation. Let's consider a scenario. A potential buyer is interested in acquiring your business. They request financial documentation, including tax returns, profit and loss statements, bank statements, and they find discrepancies between the reported revenue and the actual revenue. That raises red flags and can quickly erode trust. Remember, buyers and investors conduct thorough due diligence before making decisions. If they discover that revenue has been underreported, they might question the overall integrity, not only of the financials, but of the business owner themselves. What else is the business owner hiding? Transparency is key in the business world. By accurately reporting your revenue, you build credibility and confidence with potential buyers. A well-documented financial history helps establish a strong foundation for negotiations and facilitates a smoother transaction process. Let me give you a real-life example so you can see how this math works and just how badly it hurts your business and your valuation when you underreport your revenue. Let's say the business does $1 million top line. For the sake of easy math, let's assume that you would show, if you reported all of the income, $100,000 profit on your tax returns. Assuming you pay yourself $80,000 a year in W-2 wages and you have another $20,000 in discretionary expenses or add backs, that puts you at an SDE or seller's discretionary earnings of $200,000 or 20% of the top line revenue. But because you didn't want to pay taxes on the $100,000 that should have been on your tax return, you either underreported that revenue or stuffed a bunch of personal expenses into the business to zero out that income, thus saving you, let's call it 25% tax or $25,000. A significant amount of money, right? But here's the problem. Let's say your business and your industry would value and sell for a 3x multiple. So now let's compare side by side what happens. Underreported taxes show a profit of zero, but $100,000 of combined wages and add backs. And that gives you a valuation of $300,000. So my fancy graphic editor, video editor, will put on this side of the screen $100,000 in SDE times a market multiple of 3 equals a $300,000 valuation. Now let's compare that to filing tax returns honestly and accurately on this side of the screen. Someone who shows $100,000 profit in their business plus $100,000 of add backs gets you to a $600,000 valuation. Do you see the difference? $200,000 of SDE times a market multiple of 3, in this case, gets a $600,000 valuation. By underreporting or stuffing a bunch of personal expenses into the business to lower your taxable income, you saved yourself $25,000 of taxes, but you cost yourself literally more than 10 times that in valuation. It cost you more than $300,000 in business valuation, all to save $25,000 in taxes. So here's the lesson. If you want to sell your business for maximum value, honesty, as in all aspects of life, is the best policy. Get all your revenue on the tax returns. Don't stuff all your personal expenses into the business trying to save and nickel your dime out of paying taxes, because it kills the valuation when it comes time to sell your business. So in this case, file tax returns honestly. Not only does it keep you out of jail, but it actually helps you sell your business for maximum value, build credibility and integrity with buyers, because you're doing things the way you should be doing and you're filing honestly. Consider liking or subscribing, where I make additional videos, all to help sellers better prepare to sell their business so that one day you can exit for maximum value. Thanks. Take care.